Had you bought $100 in Bitcoin, you could have made $600 in only 6 hours. How? Candlestick pattern trading. And I'm going to break it down for you right now. My name is Mike, and I teach you how to trade right now. If you want to make money in the markets, stocks, currency pairs, and crypto, you come to the right place. Technical analysis helps us determine trends by looking at historical price action. We can use news, indicators, and charts to predict continuations and reversals, uptrends and downtrends. When it comes to chart types, there are line charts, there are bar charts. Most traders like me, we prefer candlestick charts. A candlestick chart displays the historical price movement of an asset over a given period of time. Each candlestick represents a certain period depending on the time frame you select. One candlestick could measure 1 week, 4 hours, or 15 minutes. You get to decide. Candlesticks come with 4 pieces of information: the open, high, low, and close price. The candle body represents the open and close price of an asset. In a bullish market, the close will be above the open. In a bearish market, the close will be below the open. Each candlestick can have 2 so-called shadows or wicks. The high is marked by the topmost part of the upper shadow, while the low is marked by the bottom part of the lower shadow. Finally, the color of the body shows the direction of price movement. Usually a green or white body suggests a price increase, while a red or black body points to a price decline. If you combine the various shapes, sizes, and colors of candles, they indicate market psychology. This is best modeled in a pin bar candle. A pin bar is a reversal candle that tells us a lot about price momentum. The bullish pin bar appears at the bottom of a downtrend and signals a potential bullish reversal. The bullish pin bar consists of a small body that can be any color, a long lower shadow, and little to no upward shadow. Psychology-wise, sellers tried to push the price lower, way lower, but buyers weren't having it. They rejected the low and pushed the market higher. We call this a wick rejection, and it reveals that a price increase is imminent. Generally speaking, the bigger the bullish body and the smaller the shadow, the more control buyers have. A bearish pin bar appears at the top of an uptrend and signals a potential bearish reversal. The bearish pin bar consists of a small body that can be any color, a long upper shadow, and little to no downward shadow. Psychology-wise, buyers tried to push price higher, way higher. Sellers revolted and rejected the high, ultimately pushing price lower. This too is a wick rejection, and it reveals that a price decrease is imminent. The bigger the bearish body and the smaller the shadow, the more control sellers have. A pin bar is a single candlestick pattern. There are also double candlestick patterns and triple candlestick patterns, each category possessing bullish and bearish formation. Let's break down some of my favorite candlestick patterns for each category. Patterns based on a single candle are known as single candlestick patterns. There are 4 I want to draw your attention to, beginning with the shooting star. The shooting star pattern is a bearish reversal pattern formed after an uptrend. It's characterized by a single candle with a small body located at the bottom of a long upper wick. The body of the shooting star is small and can be bullish or bearish. The color of the body is not as significant as the position and length of the wick. The most distinctive feature of a shooting star is its long upper wick, which extends well above the body. This long upper wick represents a failed attempt by buyers to push the price higher. Sellers rejected the higher price and pushed price higher. Let's check out an example using pound USD. As price makes 2 higher highs, buyers are unable to push price higher. Our shooting star appears at the top of the uptrend. Had we enter after our candlestick closed and set our stop loss target above the wick and our take profit target to a key support or resistance level, we could have made $350 for every $100 we invested, or a risk-reward ratio of 3.5 to 1. The hanging man pattern is another bearish reversal pattern formed at the end of an uptrend. The body of the hanging man can be bullish or bearish, but it's always small, representing a narrow range between the opening and closing price. The most crucial characteristic of the hanging man is its long lower shadow, which extends well below the body. This long lower wick indicates the price fell significantly during the trading session, but buyers managed to push the price back closer to the open. However, bears took control by the end of the trading session. We know this because the close price is lower than the open price. We also know this because there is little to no upper shadow, indicating buyers were not able to sustain higher prices. Let's check out an example on Bitcoin. After an uptrend where buyers were able to push price higher, sellers regained control. The hanging man candle features a long lower shadow, the wick representing a failed attempt to keep prices low. We see no upper wick. In fact, price did close lower than the open, which is a sign that sellers regained control. We could wait for another bearish candle to close or enter right after the hanging man pattern. If we set our stop loss target above the prior candle's wick and set our take profit target to a key support or resistance level, we could have made $600 in 6 hours. For every $100 we invested, we made 6 times that, or a risk-reward ratio of 6-to-1. The hammer pattern is a bullish reversal pattern that occurs at the bottom of the downtrend. It's characterized by a small bearish or bullish body near the top of the candlestick's range and a long lower shadow at least twice the length of the body. The most important characteristic of the hammer is its long lower shadow, which extends well below the body. This long lower shadow indicates that prices fell significantly during the trading session, but buyers, they managed to push the price back up by the close. Ideally, a hammer should have little to no upper shadow, indicating that sellers were not able to sustain lower prices and forecasting a market move from bearish to bullish. Let's look to Apple for an example. Despite a lot of selling pressure, buyers were able to step in. The hammer appears after 2 wick rejections of lower prices. By the time our pattern appears, buyers finally push the candle close above the opening price. This is our signal to enter. We set our stop loss below the lower wick, and our take profit target is slightly above where the forward downtrend began. 12 hours later, we exit profitably, making $600 for every $100 we invested. Our final single candle pattern is the inverted hammer. The inverted hammer pattern is another bullish reversal pattern that occurs at the bottom of a downtrend. It's characterized by a small body near the bottom of the candlestick's range and a long upper shadow at least twice the length of the body. The most crucial characteristic of the inverted hammer is its long upper shadow, which extends well above the body. The long upper shadow indicates the price rose significantly during the trading session, but sellers managed to push price back down by the close. An inverted hammer should have little to no lower shadow, indicating that sellers were not able to sustain lower prices. A bullish market is imminent. Let's head to the charts to see an example on Bitcoin. After selling pressure pushed Bitcoin into a downtrend, the bears lost control. Price consolidated and continued lower before our inverted hammer appeared. This was our bullish entry signal. We set our stop loss below the prior bearish candle wick. Our take profit target is the top of the prior downtrend. As the candles close, it takes only 5 hours to make $650 for every $100 we invested. Engulfing candles signal market reversals. These patterns involve 2 candlesticks, with the latter candle engulfing the entire body of the candle before it. The engulfing candle can be bullish or bearish, and we explore both formations next. Real quick, if you're enjoying this video, go ahead and like and subscribe below. With your support, I can continue to create free content just like this. It takes a second, and I so appreciate it. The bullish engulfing candlestick pattern appears at the bottom of a downtrend and indicates a surge in buying pressure. Sellers are no longer in control, signaling a potential trend reversal to the upside. It's characterized by 2 candles, with the second candle completely engulfing the body of the previous candle. The bullish engulfing candlestick pattern is a 2-candle formation. The first candle must be a bearish candle, colored red on most candlestick charts. The size of the bearish candle can be large or small, it doesn't really matter, although the size of the second candle surely does. The second candle needs to engulf or overlap the first candle. The bullish candle opens at or below the previous candle's close. The bullish candle closes above the previous candle's open. Thus, the length of the bullish candle engulfs the previous candle entirely. The large green candle signals bullish momentum. Buyers are aggressively entering to the market to push price higher. Let's head to the charts to see an example on Apple. Here we have a clear downtrend. Price is making lower lows until price engulfs the previous bearish candle as well as the upside shadow. This double confirmation is a signal to go long. We enter placing our stop loss below the prior candle close, and our take profit target is a key level of support and resistance. 24 hours later, we exit the trade, profitably achieving a 4-to-1 risk-reward ratio. We made $400 for every $100 we invested. The opposite of the bullish engulfing is the bearish engulfing. The bearish engulfing candlestick pattern appears at the top of an uptrend and indicates a surge in selling pressure. Buyers are no longer in control, signaling a potential trend reversal to the downside. It's characterized by two candles, with the second candle completely overlapping the first one. The bearish engulfing candlestick pattern is a two-candle formation. The first candle must be a bullish candle, colored green on most candlestick charts. The size of the bullish candle, it can be large or small. It doesn't really matter, although the size of the second candle surely does. The second candle needs to engulf or overlap the first candle. The bearish candle opens at or above the previous candle's close. The bearish candle closes below the previous candle's open. Thus, the length of the bearish candle engulfs the previous candle entirely. The large red candle signals bearish momentum. Sellers are aggressively entering into the market to push price lower. Let's look at an example on Apple. After an uptrend followed by a brief period of consolidation, price breaks to the downside. The bearish candle engulfs the previous bullish candle, letting us know it's time to enter. We short, setting our stop loss above the prior candle close, and our take profit target is the start of our prior uptrend. It doesn't take long, only 12 hours to exit, achieving a 6-to-1 risk-reward ratio. We made $600 for every $100 we invested. Triple candlestick patterns are elusive and add extra confirmation as to how price will behave next. The final two patterns we'll explore today are reversal patterns, revealing that a new trend is incoming. Let's break down the morning and evening star pattern. The morning star is a bullish reversal candlestick pattern that typically occurs at the bottom of a downtrend, signaling a potential shift from bearish to bullish market sentiment. It consists of 3 candlesticks and is considered a strong indicator of a potential trend reversal because buyers are in control. The first candle is a long bearish candle indicating strong selling pressure and a continuation of the existing downtrend. The second candle is a small body candle that represents indecision in the market. It can be bullish or bearish and reflects uncertainty among traders. The third candle is our first true sign of bullish sentiment. It's a bullish candle that closes at least halfway up the body of the first candle. This shows that buyers are in fact gaining control. The second candle is the most important. It shows indecisiveness. The candle can be a spinning top or a doji candle. A spinning top has a small body, signifying minimal difference between the opening and closing price, whereas a doji candle has no body. The opening and closing price are exactly the same. If the middle candle is a spinning top, the pattern is called a morning star. If the middle candle is a doji candle, the pattern is referred to as a morning doji star. Let's head to the eurusd chart to see an example of the morning star pattern on the daily time frame. As price makes lower lows, a downtrend is evident. That is, until a spinning top candle appears after a bearish candle. The indecision signals confusion in the market until the third candle closes. It's a bullish candle that closes above the first candle. Taking into account all 3 candles, we enter based on the formation of the morning star pattern. We set our stop loss below the spinning top, and our take profit target is the price where our prior downtrend began. Days later, we exit the trade having achieved a 6-to-1 risk-reward ratio. We made $600 for every $100 we invested. The evening star is a bearish reversal candlestick pattern that typically occurs at the top of an uptrend, signaling a shift from bullish to bearish market sentiment. It consists of 3 candlesticks and is considered a strong indicator of a potential trend reversal because sellers are in control. The first candle is a long bullish candle indicating strong buying pressure and a continuation of the existing uptrend. The second candle is a small body candle that represents indecision in the market. It can be bullish or bearish, and it reflects uncertainty amongst traders. The third candle is our first true sign of bearish sentiment. It's a bearish candle that closes at least halfway up the body of the first candle. This shows that sellers are in fact gaining control. The middle candle, it's paramount. If the middle candle is a spinning top, the pattern is called an evening star. If the middle candle is a doji candle, the pattern is referred to as an evening doji star. Let's check out an example of the evening star pattern on Apple. As price makes higher highs, an uptrend is evident. The indecision candle after a bullish candle and before the bearish candle is our confirmation of our evening star pattern. We enter, setting our stop loss above the spinning top, and our take profit target is the price where our uptrend began. We exit our trade profitably, making $500 for every $100 we invested. With so many options, single, double, and triple candlestick patterns, it will take time to build a strategy. Eventually, you'll find your favorite candlestick patterns and recognize the most reliable ones. The key is patience and practice. If you found this information helpful, all I ask is that you like this video and subscribe to the channel. It takes 2 seconds and 2 clicks, and it means so much to me. Remember to check out my other videos, and thanks for watching.